Well, okay, I want to welcome everyone. It's my pleasure to introduce Mike Ferman. Uh, Mike and I are old friends, but for many, many years, Mike headed up the wealth management at Reuben Brown. And I can tell you from a personal standpoint, he did an excellent job for me. And we've maintained our friendship over the years. And we not only have him as a FEL member, but we got him to give us a quarter report on the market. And I'm sure with everything going on, all of us are very interested to hear what's good and what's bad. So Mike, let me turn it over to you.
Thank you, Harvey. Welcome everybody to our quarterly discussion group of what's going on in the economy and the capital markets. And hopefully by the end of this hour, we'll all have a little better insight about what's happening and what we might want to do personally going forward from here. I have a few minutes of kind of prepared remarks, and then we're going to kind of throw it open to the group for a discussion. And we can talk about any topics that are on your mind or any questions that are on your mind. Okay. What I thought I'd start is kind of reflecting back on the third quarter that ended on September 30th, because I think that's probably a good place to start. And you'll recall that the GDP number that came out in the third quarter was only 2%. Remember, the first half of the year, the economy was growing at a really phenomenal clip, about 6.5% a year. And then the Delta variant hit, started really increasing case counts over the summer, and things kind of just slowed down. People stopped going back, looking for jobs. The supply chain bottlenecks increased, and the economy slowed down quite a bit. You remember that the August and September jobs reports were not very good. We have been getting 800,000 and 900,000 new jobs a month in the first part of the year, and then that slowed down to about 200,000 in August and September. And a lot of those jobs that were lost were if you kind of look at the detail, were lost in the government sector. The private sector was doing better, but a lot of government sector jobs went away, primarily teachers and people working in nursing homes. Inflation really started to pick up. It had started picking up in the first part of the year, but really we got some really bad CPI reports, 5% plus in August, September. And long-term interest rates, which had kind of bottomed out probably in August at about 1.1 to 1.2, started creeping back up to 1.6 as inflationary expectations started to creep back into the economy. So that was kind of the third quarter. Okay, it's quite a dramatic slowdown from what we had in the first half of the year. So let's kind of take a look at where we are now. Since September, the economy has really started to pick back up again, and the economy is again starting to reopen. And why is that? The coronavirus cases, the Delta variant cases, peaked in September. September 12th, as a matter of fact, was the peak of the Delta variant, and the cases started to head back down again. And they're down quite dramatically from where they were. In addition, we started to see the economy reopen again. You saw the October jobs report came in much stronger, 535,000, and they revised upwards the August and September reports as people started to go back to work again and look for jobs. Long-term interest rates ticked back up to about 1.6%. And you look at the purchasing managers index numbers. These are what they call the ISM purchasing managers index numbers for the service sector and manufacturing. They have dipped down during the third quarter to the high 50s. Well, they bounced back up into the mid 60s. Both the service sector and manufacturing sector jumped back up into the mid 60s, some of the highest numbers we've seen in many, many years. That's just a reflection that the economy is reopening again. And we also saw that the inflation picked up quite a bit. Now we got my phone's ringing here, folks. So just kind of ignore that. Life happens. All right. Can't help that. So inflation is rising. And then we had a number of improvements on the vaccine front. The CDC and the FDA approved vaccines for children 5 to 12. So kids are now starting to get vaccines. And then we had both Merck and Pfizer announce new pills to treat coronavirus. So if somebody does get it, we now have better treatments to help people, fight that disease. And that's given, individuals confidence to go back to work. And that's what the economy is starting to go again. We had a very strong retail sales number in September, up 13%. Plus, if you kind of look at some of the recent reports from MasterCard, their estimates are that the shopping for the holiday season is going to be up 10%. Those are signs that, consumers, which are 70% of the economy, have lots of money and they're intent on spending it. In addition, we just recently got the Congress passed a new infrastructure bill, $1.2 trillion. Again, that will probably add some additional stimulus to the economy, maybe not in the next few months, but going out a little bit further. And the Fed is still on hold. So the Federal Reserve is still going to be very accommodative. They're starting to taper, which has reduced their bond buying program. And if you'll recall, they had been buying $120 billion a month in mortgage-backed and treasury securities. The Federal Reserve now owns 40% of all the long-term treasuries that are outstanding. 40%. They have like a $9 trillion balance sheet. It's amazing. But they're starting to taper, and they're going to reduce those bond buying by about $15 billion a month. And they plan to be through with that probably the middle of next year. And then they'll start, at least Powell has said, they'll start thinking about raising short-term rates after that. We'll see. It kind of depends upon how inflation goes. Right now, the numbers aren't looking too good. And we finally got an acknowledgement from Powell during his testimony and his question and answer period that he no longer thinks inflation's transitory, which means it's going to be around a little longer than they originally expected. We'll have to see how long it persists. Hopefully it will abate as some of these supply chain bottlenecks work themselves out. Let's see, what else do I want to say here? Oh, in the jobs report, wages are up 4.9% year over year. That's good. I mean, that's probably the highest rate of wage gains we've had in a long time. But if inflation is going up 6.2%, unfortunately, workers are still falling further behind because their purchasing power is again being diminished. Let's see. What's also very interesting, the S&P 500, the companies started reporting their earnings for the third quarter in October, and it continued that in November. And surprisingly, 85% of them are beating their earnings and revenue forecasts, and they're beating their earnings estimates by 13%, which is huge. And what that really means is that most companies have pricing power. And although their costs are going up with inflation, they're able to raise prices to maintain their margins. So that's one of the reasons that the earnings outlook for companies based on the data they've been reporting for the third quarter is looking pretty good. Interestingly, if you look at the forecast or S&P 500 earnings in 2022, it's now up to $220 a share, which is significant. That puts the forward operating price earnings multiple at about 21 times. At the beginning of 2021, the forward price earnings multiple was at about 23, which, although stock prices are up and we're at new record highs, stocks are actually a little bit cheaper based on estimates for forward earnings than they were at the beginning of the year. I know that you kind of scratch your head and say, how can that be? It's because the earnings forecasts and the earnings estimates continue to rise as companies are able to pass along the rising costs, which means their revenues and their earnings can continue to grow despite the bottlenecks and despite the inflation. I just think what will happen when the bottlenecks eventually go away. Earnings forecasts could rise even further, which is good for stock prices. Let's see. Looking at some forecasts, I've read a number of economic reports from a number of the big Wall Street brokerage firms. They've raised their forecast for GDP for the fourth quarter to about 4 to 5%. That's up from the 2% we had in the second quarter. And as they look into 2022, they kind of see that, at least for the first half of the year, staying at around 4 to 5%. In addition, the IMF raised its global growth forecast for 2022 up to, let's see, 4.9%. What that really tells me is that a lot of the momentum that was lost in the third quarter, when things kind of slowed down, all that was not sales and business lost. It was just sales and business deferred, which means a lot of that will come back in the fourth quarter and into 2022, which is good for continued economic growth. Again, with the new infrastructure bill, I think it's important to realize that with infrastructure, there's a lot that has to happen before a shovel goes in the ground. So expectations are there might be some benefit in the short term from the new infrastructure bill, but a lot of that you won't start seeing and hit the economy until maybe 2, 3, 4 years out from now, as it takes a long time to get plans drawn up and get permitting and environmental impact studies and yada, 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 yada. So don't expect a big impact from the recent infrastructure bill that was signed yesterday to come into play for the next 12 months or so. Let's see. So kind of expect the economy to continue to reopen. Well, what does that kind of mean for markets? Well, interest rates. If inflation is raging at 6.2% a year, and the economy's reopening and growth is picking up, expectation is that long-term interest rates will continue to move up. They're currently at about 1.6%, and a number of the estimates that I've seen are somewhere by the end of this year, maybe at 1.75%, and maybe by the middle of next year, 2 to 2.25%. Not high by historical standards, but certainly much higher than where we are today. And of course, we know what the impact of rising interest rates are on asset prices. Everything's priced at discounted cash flow. So that's negative for asset prices. Interest rates going up, discounted at a higher rate means asset prices are lower. It's also not good for bonds, because bonds today with lower rates, as interest rates go up, bond prices drop. Let's see. Again, we're starting to see, as you look overseas, we're starting to see the number of vaccines and people getting vaccinated increasing. That should help the emerging markets and other economies overseas open up as well, and also help alleviate some of these supply chain bottlenecks we have. As the supply chain bottlenecks tend to work themselves out over the next 6 to 12 months, you probably will start to see inflation abate, but not go away. Because remember, inflation is primarily a monetary event. And as we've talked before on other calls, the money supply is up 36%, okay, since the pandemic started, which really is inflationary, because it helps stimulate more demand, and there aren't the goods to meet that demand, which drives up prices. Kind of looking at, well, all of that's interesting, but so what? How does that impact our investment decisions? Well, remember, in a as the economy opened up at the beginning of this year, the types of stocks that did really well were those that were more economically sensitive. So cyclical stocks, industrial stocks, financial stocks, material stocks that did very well as the economy reopened. As things started to slow down in the third quarter, there was a rotation out of those economically sensitive stocks into more growth-oriented stocks because investors were looking for companies whose earnings and revenues could grow. But as the economy again begins to reopen and growth picks up and inflation picks up and interest rates pick up, there's been another rotation back into those more cyclically oriented stocks. And more recently, you started to see them do better again, as opposed to the more growthy stocks. Again, stocks with high price earnings multiples get hurt the worst when inflation and interest rates go up. So there's been a rotation out of some of those high multiple stocks into more economically sensitive stocks. And I would expect that to continue going into 2022. Let's see. Also interesting enough, and something we've talked about before on these calls, foreign stocks typically trade at a discount to US stocks about 13%. Well, that discount is closer to 20% today because those economies haven't benefited as much from the vaccine rollout as say Europe and the United States have. As vaccinations in those countries overseas start to pick up, I think you'll start to see economic activity and profits and revenues in foreign companies pick up as well. So there may be an opportunity there as well for some investment funds to flow because they're trading at a much deeper discount than they have historically. It's just some place to think about where you might want to put some money going forward. Let's see here. I think that's probably enough to kind of give you a picture of where things are. Things are much better, and the big takeaway is the economy is reopening again. The number of coronavirus cases is going down. Economic growth is picking up, which is good for stocks. But we have to be worried about inflation and interest rates because inflation and interest rates impact valuations. So focus on more cyclical stocks, kind of look at maybe smaller cap stocks as they benefit from reopening, and take a look at stocks overseas because they're trading at a pretty significant discount. Be careful about buying long-term bonds because they'll get whacked a lot more than shorter and intermediate term bonds if interest rates go up. And look at things like materials and other things which are highly, and real estate too, which are again good hedges against inflation. So I'm going to stop there, kind of open it up for questions, and let's have a discussion. Who wants to be first?
Ken? You have
You're
to
on mute,
unmute.
Ken. Ken, you're on mute.
How's that better?
That's better.
Yeah, I have two questions.
Yeah.
One is, how is this different than the Carter days?
Oh, God.
The Volcker days? And
Well,
the
the inflation, remember back in the 70s and early 80s, inflation was double digits. It was twice what it is now. So this is not the type of hyperinflation that we had back in the called 70s and early 80s, okay?
Okay.
And a lot of that was caused by an oil shock, okay? Back then, we were much more dependent on petroleum and oil, which really hurt prices a lot. It drove prices up into 12 and 13%. We're not there, okay, yet. We could be if we're not careful, all right? But we're not there yet.
And the second question is a specific stock called Rivian.
I'm not going to comment on specific stocks because again, I'm not a stock analyst.
Okay.
Rivian is a brand new EV company.
Right. All right. Thank you very much.
Yeah, it's only produced 156 cars. So
Yeah, I know.
beware. Yes. Next question.
We have Steve Loeb or Irv. Steve, you want to go first and then Irv?
Okay. President Biden seems to be getting a lot of the blame today for inflation. Realistically, what can our president, any president, do to slow down inflation?
Well, I think it's important to sit back and reflect, what are the causes of inflation, okay? Increase in the money supply, supply chain bottlenecks, increases in the cost of input costs, labor costs and material costs, and increases in demand. Inflation's caused by supply and demand imbalances. So how do you fix that? Clearly, you can impact the supply imbalances by working to try to get goods flowing faster in the economy. Now, he's done some things by trying to go out to California and talking to the dock workers, et cetera. That's important. But also, you have to be sensitive about the supply of money that's pumped into the economy. The money supply is up 36%. And what we've learned from Economics 101, remember Milton Friedman? We were all in school and, we're teaching economics, that he said primarily inflation's a monetary event. You increase the supply of money without a commensurate increase in production capacity, you get inflation, because people have more money and they want to spend it. There just aren't enough goods around for them to spend all their money on, so prices go up. So we've got to cutting back on the supply of money would be very important, okay, as well. Running large unfunded deficits, borrowing more money and pumping more money into the economy can exacerbate inflation, okay, if it's not met with offsetting revenue sources. So we have to be sensitive of not to print more money or print less money, and try to alleviate the supply chain bottlenecks. Try to work with local governments and state governments to help the flow of goods across the country, and to encourage more people to go back to work. It's not going to be easy, okay? But it's very important to watch how much money we're printing, and to make it easier for people to go back to work and not give them incentives not to work.
But he has no control over the monetary picture.
Well, no,
that's the Fed, right?
Well, let's kind of think back to that $2 trillion spending bill they passed earlier this year. A lot of that was just money that was just given to people. Okay, so Congress can certainly influence it through bills. You just can't flood the economy with money and not expect to have some impact on inflation. So he's got to work very carefully with Congress not to pump too much money into the economy, because that could make inflation worse, and that could cause, again, a greater increase in supply. It's not going to be easy.
Irv, did you have your hand up and you need to unmute?
Irv, unmute.
Irv, you're on mute.
Unmute
Irv,
yourself.
you're on mute.
Okay,
Irv,
That's better.
there you go.
okay. I didn't want to, okay, question. About 2-3 weeks ago, I saw where an analyst from Bank of America said that the Brent crude by June of next year will be $120 a barrel. Now, what that's going to do to the price of gasoline? Right now, California is approaching $5 a gallon. I think they're the highest in the country,
Right.
For regular unleaded. Looks to me like by June, if that holds true, it also said that price of the Brent crude is what drives our gasoline prices here. So I'd say we're looking at least $5 a barrel here in St. Louis, and golly, who knows what it'll be in California. I don't see any president. I mean, it's kind of like trying to get a tiger by the tail that's going to be able to do anything about it. So my question is, will the Fed be able to do anything about this inflation that really seems to be starting to run away?
Remember, the Fed has two mandates: to try to keep the unemployment rate low, and to try to control inflation. how have they typically controlled inflation is raising interest rates to help damp down demand.
Just wait.
We won't stay in here.
Well, I'm gone.
Well, hold it. We have some, put yourselves on mute, folks.
I
Okay,
I
yeah,
got
we're talking about, so the Fed has two mandates, okay? So the inflation mandate, they control demand by raising interest rates to try to damp down demand, all right? But you're right, the petroleum, not only gasoline, but petroleum gets in the manufacture of almost everything.
Right.
Okay, it's in the chemicals, it's in the plastics, and anything we buy has got a lot of petroleum-based products in it. And we've really restricted the supply here by shutting down pipelines and other things, which really slow down and discourage the production of petroleum here in the U.S. Remember, a couple of years ago, we were energy independent. We were supplying everything we needed. Now we're back to importing again because there's been a lot of shutdown in production here in the U.S. And interestingly, we're now going to OPEC and some of the others who are trying to get away from and asking them to produce more. So you have to be careful about oil because oil gets into production of everything and is one of the primary components in the cost of materials.
Right. Don't you think that's really going to drive up the sale of electric vehicles?
I don't know. Okay, it depends on demand. They've got to make electric vehicles attractive so people want to buy them. Now, part of the new bill that's going through Congress are big subsidies for people to buy electric vehicles. If that passes, if you get a big subsidy to buy an electric vehicle, you think about it. But they're also putting a lot of money into building charging stations around the country because one of the big drawbacks now is you buy an electric vehicle, how far can you drive it before you run out? And can you find a place to recharge it? So the answer is I don't know, but maybe.
Yeah, I saw too that $7.5 billion in that infrastructure bill to build out these charging stations. There was a target of something like 11,000 of them, I think. Of course, there's independent companies that are in competition with each other.
Of course, and you have to ask yourself. I'm not making a political statement here, but should the government be doing that, or should the private sector be doing that? That's another question. Other questions? Who else has a question?
I think Marilyn,
Hi, am
Hi,
I on
Marilyn.
mute?
you are.
You're good.
I have a couple questions.
Sure.
Are they jacking up this inflation rate so that they can have higher dollars to tax with the new tax law coming in? I have several questions. You want them all at once or?
Well, let's do it one at a time because I won't remember them all anyway. You'll forget we're all contemporaries here, and my memory's not very good.
Okay.
Well, are they deliberately trying to? No, nobody wants to jack up inflation. They're not trying to jack up inflation deliberately. It may happen as a consequence of their actions, but I don't think anybody's focused to deliberately jack up inflation.
At what point does inflation turn into depression?
Well, for example, if inflation is raging and interest rates go up, that will help dampen demand and will slow down GDP growth. Remember and going back to the question that somebody asked earlier about the Carter days, remember that Volcker stamped out inflation by raising interest rates to 20%. Anybody remember the 20% federal funds rate?
Banking.
Exactly. That's how you dampen down inflation, by suppressing demand. When you suppress demand enough, you can cause a recession.
And also, China is trying to get their currency to be the world currency.
Right.
What happens? What are the conditions that can make that happen? And if the dollar is devaluated, what would happen then?
Well, right now, as you correctly state, the dollar is the reserve currency of the world. China would like its currency to also be one of the reserve currencies, like the yen and the euro. Okay, but their economic system has to change to get people to be willing to accept it. Because remember, you become a reserve currency by building trust among the other people around the world to be willing to accept it. So they have to adopt policies they give other people confidence in their economy. They haven't been able to do that yet. Okay, no one knows for sure if they're going to be able to do that, but they have to really work a lot on their economy, develop good liquid capital markets, allow more private they have to do a lot of things they haven't been willing to do yet. So they're a long way from becoming a reserve currency at this point. Doesn't mean they won't at some point, but they got to do a lot more work.
And one more question. I don't want to tie this up. India's being awfully quiet, but yet they could become a world power.
Absolutely.
When do you see that they will kind of raise up above maybe everybody else?
Well, it could be a long time because obviously they're still a developing country. And they have to, again, continue to adopt, I'll call it more economically friendly policies, develop capital markets. They're certainly emerging. But remember, it took the U.S. over 200 years to get where we are now. India's got a lot of people and a lot of potential. It has at least a democratic system of government, which enables private enterprise to prosper and to grow. They've got to adopt more economic policies to foster that. It could take them a long time.
Thank you.
Who else has a question?
Bill
Bill
Livingston.
Go ahead.
Hi, Mike.
How you doing?
Good. Doing well. Given the bottleneck, the supply chain bottleneck being caused in a great part by lack of truck drivers, lack of trucking, lack of the ability to get things from the ports to their destinations, how long do you think it's going to take before we see any real change in availability?
Well, that's a good question, Bill. I don't know. Okay, that's the honest answer. All right. Obviously, more people have to come back into the workforce. Okay, there's a shortage of jobs, so wages have to go up to make people more attractive. A lot of the supply chain and the movement of goods across the country is controlled by state and local governments. Okay, and for example, in California is an example. You can't drive an empty truck from one point to another with an empty carriage on it. You have to have a load. Those restrictions make it harder to move goods around. So a lot of state and local governments have to look at their rules and regulations and do things that are practical to get goods moving. A lot of the stuff that's been put in place, okay, is restricting the supply chain. So a reduction of regulations would help a lot as well. So it's going to take higher wages, trying to encourage more people to come to work. There's going to be changes in regulations to get goods moving. It's going to be improvements in the infrastructure on the ports. And a lot of the money in the infrastructure bill is to improve the port so they can load and unload ships a lot quicker. So all those things have to happen, Bill. Okay. Plus, remember, you have a big increase in demand caused by printing of money. So people are demanding more goods that are available. We're producing more goods now than we were back in 2019. It's just the demand is so much greater, which is causing some of the supply chain bottlenecks. Plus, things will also improve too overseas as more people overseas get vaccinated. Their factories will reopen and goods will start flowing a lot faster. So it'll take a while, but I think you'll start to see some of the supply chain bottlenecks abate maybe in the middle of next year at the earliest, because they're going to be around for a while.
I have a question.
Yeah.
Is there a way for the public to see how much money is being printed per day, per month, or something like that?
Well, you can go to the Federal Reserve website. They tell you what they're doing. They're very transparent.
And
Federalreserve.gov.
what is the normal amount of money in general?
Well, it varies, okay? Right now, because of the quantitative easing, remember, quantitative easing is just another term for printing money, okay? As the Federal Reserve goes in the basement, they push the button and they print money and distribute it. So it is quantitative easing is reduced through the taper, the Fed eventually has to start reducing its balance sheet to reduce the money supply. Again,
Yeah,
which will put upward pressure on interest rates.
I read yesterday that that 40% of the circulating money is from this year, printed this year.
Well, that again, the money supply is up 30%, 36%. That's correct. It's up 36% because of quantitative easing and huge deficit spending.
Thank you.
Other questions? Anybody for the group? Has this been helpful, folks?
Mike, the Wall Street Journal today had a big write-up about people going in more into gold.
Yes.
What do you think of minerals and that as a buy as opposed to stocks?
Well, I think materials are a good investment, especially as the economy reopens. And I wouldn't, people kind of look to gold as an inflation hedge. And historically, that's true because they look at it as a store of value. But what's the best inflation hedge there is? It's owning stock in a company. Because companies can raise prices and generate cash flows, and they own assets. So there's a great concern about inflation. The Fed for many, many months said inflation was transitory. And the prices of gold and other precious metals didn't go up much because a lot of participants in the market believe that. As the Fed has backed away from its transitional language, more and more people have become to believe that inflation, we're going to be at a higher rate of inflation for a lot longer than people think. And so they started to look at, in addition to stocks, but other assets like real estate and gold and other precious metals as hedges against inflation and stores of value. And I suspect that will continue until the rate of inflation abates. Because of all the money that's been printed, we're going to be operating at a higher rate of inflation than we've been used to for the last 15, 20 years. Remember, inflation for the last 20 years has been running at 1.5% to 2%. With all the money that's been printed, it's probably going to settle in. It will abate from the 6% we have now, Harvey, once a lot of the supply chain issues get worked out. But it was probably going to settle in at a much higher rate than 1.5% to 2%. Maybe 2.5% to 3% or 3% to 3.5%. That's and people are taking note of that and trying to protect themselves because your purchasing power of your money goes down with inflation. So people are looking for places to maintain their purchasing power. Gold is just one of them.
Is there an ideal number?
I just wonder if anybody remembers what the mortgage rates went to when Jimmy Carter was president.
Yep.
We had a heck of a raise in inflation back then.
Yeah, I remember my first mortgage on my first house was 16%. Hopefully we're not there yet, folks. Okay, and I don't expect that's where we're going to be. Okay, but it certainly brings back bad memories.
Is there an ideal inflation rate?
Oh, ideal. I think a lot of economists kind of look at 2% as kind of ideal. It's not going up so fast that people's purchasing power is being eroded dramatically. But also allows the government to pay back its debt in dollars that are worth a little bit less. I guess they'd rather have a little bit of inflation than deflation, because deflation means slower growth, more unemployment, et cetera. So you don't want, no, inflation per se is not necessarily good, but a low rate of inflation is tolerable. If you can keep it around 2%, we could probably all live with it. But we're probably going to be at a higher rate going forward. I guess that's my guess. I really do.
we have Irv and then we have Marilyn.
I just
Irv?
one comment on the other side of that. My father-in-law had a few CDs back in the days when Carter was president. He was loving it because he was getting like 12 and 13% on his CDs.
You know, hopefully we don't have that, because if inflation's at 12 or 13%, you don't make beans. It's like everybody touts the rise in wages that we've seen in these recent job reports. That's good. But if wages are going up 4.9% and inflation is going up at 6%, you're losing purchasing power. So people shouldn't be happy with that. And they're not.
Yeah, okay. I'm a student of history, and history sometimes repeats itself. What would happen if China had a revolution, especially with this problem that they have with their real estate problem, where there's over 1.5 million people who bought apartments that they can't get into because China hasn't been able to build them. It was a big scam. So what would happen if they had a revolution and we have all our industry over? I mean, we have so much of our industry over there.
Well, as we all know, China is the second largest economy in the world today. It's like 17% of global GDP. If they would have a revolution and their economic growth would grind to a halt, that would have a dramatic impact on global growth, because they're one of the biggest manufacturers of goods in the world, one of the biggest users of materials in the world. And we have a lot of stuff that we all use every day that's manufactured in China. I mean, that's where Walmart and Costco get a lot of the stuff that we buy every day. So that would clearly have a dramatic impact on clearly the supply chain. Plus Chinese, they're developing a consumer economy, and they have a lot of people in China that buy a lot of stuff from everybody else. So it would be a really negative impact on global growth.
Is anybody forecasting this type of thing of other countries' instability?
Well,
that could have a big effect on us?
Well, it could happen anywhere at any time. That kind of stuff's hard to predict. I haven't seen any real reports. It's clearly something the Chinese are worried about with their economy slowing down. Okay, they've got to maintain control and keep things moving on. But I don't hear anybody predicting they're on the verge of imminent collapse.
If China had difficulty in their income aspect, they would just invade Taiwan and bring the whole country together.
Who knows? Let's hope not. Again, this is an economics and capital markets discussion. I'm not necessarily going to get into geopolitics. I know even less about that.
Yeah, but it all affects the market.
It does. We clearly would. It would create instability, and markets don't like instability and uncertainty. Who has another question? Anybody else that hasn't had a chance to speak up yet would like to ask a question?
I don't see any at this time. You could raise your hand or unmute yourself. And
folks, have you found this helpful or interesting?
Oh, yeah.
Mike, one other question. The first infrastructure bill was passed.
Right.
And I think that's going to help, with the roads and everything else. But the second infrastructure bill, if it's passed, with human resources, that's just going to be dumping more money and producing more money. What effect do you think that's going to have on the economy?
Well, again, it's a bill that contains a lot of additional entitlements, okay? We have things like Medicare and Social Security now that we're having a hard time funding. And if we add more entitlements onto it, it's more things we're going to have to support in the future. All depends on, Harvey, where they're going to get the money to pay for all these things. And that keeps changing every day. If it's going to turn out that we have to fund these things and the revenue sources that they identify to pay for this stuff don't materialize, which is a strong possibility, that means the government's going to have to print more money again, that's just adding to the money supply and increasing the deficit. Any of these entitlements that get passed have to be paid for, okay? And I don't care what time frames they put on them, that they expire in 2 years or 3 years. We all know that government programs, once they're in place, never go away. So we're going to have to figure out how to pay for these things over the long term. And the only way to do it is to raise taxes, not on just rich people, but everybody. Because we have to be able to pay for them. Other
I think,
questions?
Jerry, do you have a,
Yeah, considering taxes and so on, how realistic is it that the very rich and the people earning, $400,000 or more are going to pay for all of this, as opposed to the reality, which what I think is the reality, that is that the middle class is the one that has the money, doesn't have the resources to hide the money, and is going to end up paying for it in bulk. How realistic is that?
Jerry, I think you probably identified the issue. Wealthy people don't have enough money to pay for all the proposed bills, but the structure of the bill changes every day, so I don't know how it's going to come out. But clearly, the money is with us. Okay, the money is not with the 1%. Don't have enough money to pay for all this stuff long term.
I'm
Can
not
I
seeing,
answer your question?
Yes, yes, you did. It was the answer I expected.
It's what it's. I think you've identified it. Okay, that is, rich people should pay their fair share, but they just don't have enough money to pay for all this stuff themselves.
Well, not only do they not have enough money, they also have the resources,
To hide it.
accountants, lawyers, et cetera,
Sure.
to be able to hide the money.
Sure.
And they're very, the Panama Papers, is a perfect example, and it's probably just the tip of the iceberg, I think.
No, I understand. Additional questions? Anybody else?
I don't buy bacon, but I was curious. I had heard about the price going up. You look about this inflation. So I was at a grocery store a couple of weeks ago. I just walked over to the case where they keep the bacon in the open cases. I picked up a package of a well-known brand. I can't remember the name of it now. It was a 12-ounce package of bacon. It was $14 for a 12-ounce package of bacon, which probably by the pound then makes it what, like 18, 19, whatever. It's 3/4 of, every 4 ounces was like 4 something, I guess, somewhere in that range.
Yeah, go to any restaurant.
Over
Yeah.
4. That's amazing.
Yeah, go to any restaurant and look at the menu prices. They're all higher. Everything is more expensive. Okay, and the stuff we buy every day is up more. It's important too in the CPI numbers. Rent is a big portion of the CPI number. And because housing price has gone up, the rent equivalent hasn't really creeped into the CPI numbers yet. There's usually like a 2-year delay in that. So the CPI numbers we see every month are going to start to be negatively impacted by the rent equivalents. They start to build into it because of the rise in real estate and home prices. And that hasn't even been reflected yet. So it's going to continue to go up for a while. Again, the Fed has kind of backed away from their transitory language. They don't believe anymore that it's transitory. Some of it, not all of it, but some of what we're seeing is going to be permanent. I see a question's come in. Would you recommend buying blue chip stocks with dividends? Sure. Again, good quality stocks with good balance sheets and good cash flows should do well in an inflationary environment because they have the ability to raise prices, improve their cash flow, and increase their dividends. So again, high quality companies are good to buy, and a company with a rising dividend and a good balance sheet and good cash flow is a good long-term investment and hedge against inflation. So the answer to your question is yes. Again, try to avoid companies that have high price earnings multiples. Because remember, discounted cash flow and rising interest rates, companies with high price earnings multiples, and those are typically, the smaller mid-sized technology and biotech stocks, their stock prices are more vulnerable to rises in interest rates. So companies with lower price earnings multiples, good strong balance sheets, good cash flows, those are the kind of companies to kind of focus on, because they're less risky in a rising rate environment. Rising interest rates negatively impact all asset prices, all. The current market multiple is about a forward PE of about 21 times. So stocks that have high price earnings multiples are higher than, say, 20 or 21 times forward earnings. Because as interest rates go up, the price earnings multiples compress and vice versa. So one of the reasons the stock market's gotten up to the valuation it is because interest rates are very low. As interest rates rise, price earnings multiples will compress. So good quality stocks with price earnings multiples, let's say 20 or 21 or lower, are probably less susceptible to rising rates than those that have much higher price earnings multiples, like 30 and 40 times forward earnings.
There's another question from the same person, Tigger. What number of PE I need to think about? And
Yeah, that I was just answering that question.
I'm sorry.
Judith. Okay. There's
Okay.
another one. I wouldn't buy anything over. You got to be real careful. 50 PE is pretty high. Remember, I know you're all too young to remember this, okay? But back in 2000 and 2001, they had price earnings multiples on companies that were like 100 or 150. Anybody remember those days?
I do.
That's kind of scary. Don't buy those. Don't buy those companies.
I thought it's really interesting. Rivian, that's that new electric vehicle.
Right,
company.
right.
They haven't built a tire yet, and the stock's going out of sight.
Yeah. Remember, things go a little crazy. Okay, at the tops of markets, it's an EV play, and it's really popular right now. But you got to be really careful with those high PE stocks that don't have any earnings yet, because their stock prices are highly vulnerable to a rise in rates.
All the Rivian.
Rivian might wind up building a bunch of Yugos.
Who knows?
And there you go. All this money, and then the cars turn out to be a pile of junk.
Yeah, don't necessarily buy the hot thing, because the hot thing may not be hot forever. Okay.
Amazon owns almost a quarter of Rivian, and Ford owns a bigger piece, and Cox owns a big piece also. So they have a lot of money behind them.
Yeah, you got to be really careful about stocks with high price earnings multiples, okay? Because their future expected earnings are way out in the future, and those earnings that are earned way out in the future get discounted quite significantly when interest rates rise. So be very careful of buying stocks with high price earnings multiples. Any stock, it's just higher risk. Don't let it be too much to your portfolio.
Marilyn?
What about Bitcoin?
Bitcoin. I'll give you my opinion on. I think Bitcoin. I would never invest in Bitcoin. To me, it's just a fad. It has no intrinsic value. Now, I think the technology it's built on is really fascinating. Which is blockchain, which can be used for many things. But a lot of people advocate Bitcoin as a store of value and a hedge against inflation. And me personally, I think that's nonsense because it's backed by nothing. And just because somebody goes into a basement and manufactures a Bitcoin and because it's scarce, doesn't mean it has any intrinsic value. So I'd be very careful about Bitcoin. It's something that can be very risky. It's certainly its price is quite volatile. It's backed by nothing. So I would just be very careful. Doesn't mean we won't be using digital currencies at some time in the future. I would just be very careful of anything that like that somebody just creates out of thin air. and create, and just because it's scarce, it means it's a hedge against inflation and it's got intrinsic value. I just don't believe that.
As a note, Fel and Mirowitz, we are sponsoring a program on November the 30th, which is going to focus on cryptocurrency and Bitcoin. So if anybody is interested, just from a general standpoint, to learn more about what it is, we have a program coming up. You guys have set that up as well, Fel program.
Right. I think that'll
So-
be a very interesting conversation.
Yeah.
Other questions? Somebody just passed the note along that says, don't invest in anything you don't understand. That's very sound advice. Don't invest in anything you don't fully understand. I agree with that. Other questions anybody has?
Well, it's time for my nap, so I think I'm gonna sign off.
Okay,
Thanks, Mike.
good talking with you.
We're
Look
getting
forward to
close.
seeing you guys next quarter, okay? I'm sure
Very-
we'll have new things to talk about.
It was very informative. Thank you.
You're welcome.
So we've got a couple more minutes. If anyone has another question,
Please raise your hand and let's talk about it.
Okay, I'm going to ask a question.
Okay,
There was a program on 60 Minutes last week about lithium and the demand for lithium and how we're depending on foreign countries for lithium. And there's now new companies coming out in the United States. So lithium is just as a symbol of what these rare minerals and minerals and things that are needed for instance, for the electric cars and batteries and for future. So, do you have any comment about in general or lithium in particular?
well, I'll make kind of a general comment. We have very aggressive alternative energy ambitions. But to do that, you got to have all the resources available to enable those ambitions. And with a lot of the environmental restrictions that we have here, it means we can't produce a lot of those materials that we need to meet our alternative energy ambitions, and we have to go overseas to get them. And a lot of the things we need are supplied by China. that just creates a dilemma. So we have very, very large ambitions, and we right now we currently lack the capacity to deliver on those ambitions. Doesn't mean it won't change in time, but right now there's a big gap.
we have one more question, and that is from Jonathan Daner. Should the National Guard be used to help with logistics at ports?
That's a political question, not an economic question. And it's not the purpose of the National Guard, okay? So I would just kind of leave it at that. That's not what they're
Okay.
there for.
Okay. So I think that's it for the questions for today. We are right at 11, getting close to 11 o'clock here. So Harvey, did you have anything else you wanted to add for the day? Okay. All right, Mike, thank you so much for
Thanks, Mike.
very informational program today. And thank you everyone for your questions and discussion. It was great. And so we will schedule it for next quarter, and Mike will return with some new information maybe.
And there's always new
Always new
information. In the economy. Always something new.
Okay.
See
All
you
right.
all. Bye.
Okay. Bye, everyone.
Thanks, Mike. Stay well.
I will. Bye, guys. Get your heads
Very
down.
informative. Thanks.
Bye-bye.
Bye.